Welcome, everybody. My name is Jeff Green, president of Green Team Realty. Thank you for joining us today. We're joined by Celine Derland Insurance, and we're going to be talking about home insurance myths and misconceptions. We have some very interesting things to talk about as it relates to home insurance and real estate. I know that that may not seem so compelling to you, but I promise that it will be. There's always some hangups that happen in the real estate transactions. So Garrett Derland, welcome. Why don't you go ahead and introduce yourself and your crew that you brought with you today?
Absolutely, Jeff. Thanks so much. Appreciate being here this afternoon, and hopefully we can demystify some of the myths and misconceptions for you. I'm Garrett Derland. I hope many of you know me. Office has been around since 1934. I've got 40 years in the business, which is unbelievable as of December. With me today is Michelle Dixon and Brianna Smith, and two of our very key professionals here, and they do business in personal lines specifically. So, you know, let's move right into it, because I know we've got a lot of ground to cover, and we want to be able to have a question and answer session here. So
that's great.
You know, let's move right in, and we can actually skip Jonathan. I don't know if you're controlling this. We can shoot right past the introduction pages and get right into the fun stuff. There it is. There it is, the fun stuff. Now, this is a little misleading, this graph, because in fact, as many realtors probably know, flood insurance is not covered under a homeowner's policy. It is a separate animal, and you've probably been in situations where, you know, you get to a closing or you're near a closing, and all of a sudden the lender needs flood insurance. So I will tell you that we have a very robust a number of carriers that we can get that done, and we can get it done quickly for you. But earthquake coverage actually can be endorsed to the policy. I will tell you that that actually experts have been talking about for probably 25 years that the Ramapo fault line, which runs very near us, is going to become active one day sometime soon. So that's something that we always talk to our clients about, that earthquake coverage. You actually can buy earthquake coverage, and it's not that expensive. However, if you're unfortunate enough to have a flying axe hit your house, you actually do have coverage for that, because there is coverage for falling objects, and there's no definition of what a falling object is. So there would be coverage for that. So, you know, insurance can't live without. I mean, if I had $1 for a number of times that I said, you know, that I heard people say, you know, insurance is a necessary evil, that is, you know, I'd be rich, that's for sure. But moving on, probably one of the biggest misconceptions, or should I say one of the most important misconceptions, results, and I'm waiting for John. Jonathan, did we lose you?
Hey, Garrett, are you seeing the screen?
Oh, now I'm seeing the screen.
Okay.
All right. All right. Actually, one back. You went one too far. So this has been true for a lot of years now, and I'm probably talking about 15 years, that the industry has been talking about the fact that 3 out of 5 homes, and by the way, it's not just homes, it's actually, this bleeds into commercial property as well, are underinsured, and meaning insured to value. And one of the biggest reasons for this is the misconception between market value and insurable replacement cost. And we've been fighting this battle for, well, forever. I mean, because, you know, somebody's buying a house for $400,000, and, you know, well, why do I have to insure it for $525,000? Well, there are reasons for that. And if we go to the next screen, the main reason for that is that, you know, and I'm waiting for you, Jonathan.
Yeah, it seems as if there's some sort of a delay here, because when I change screens, it doesn't seem to be reflecting for the rest of you.
All right.
I'm not sure why that's happening.
Well, I'll give you a little bit of a heads up. There we go. The main reason for that is that there's simply a difference between obviously market value, what a home, you know, is going to sell for, versus what it's going to cost to build a home new, which is actually still less than what it's going to cost to actually restore or repair or replace a home. One of the major aspects of that, of course, is the cost of labor involved. And cleanup costs and debris removal, which can run into the tens of thousands of dollars, sometimes in excess of six figures, right? Depending on the type of loss, the size of the home, that sort of thing. So these are factors that are built in to an insurable replacement cost. And so, you know, when we're talking to our clients, I mean, you know, we're always having that discussion, right? Because usually, as a matter of fact, the last time I think it's been flip-flopped is back in the bubble. Jeff, you may or may not remember this, right? 2005, 6, right? Where housing prices, the market values were just huge. They were,
Sure.
you know, they were enormous. And we actually were coming up with insurable replacement costs that were less oftentimes, and lenders were saying, you know, hey, you have to provide me a binder for $800,000 on a home where the insurable value was $675, you know. So we fought that battle a little bit, but more often than not, it's the other way around. It's market values are here, and insurable replacement costs are somewhere in excess of that. So talking through that with clients is key. And one aspect which I'm going to just touch on this, it's not on the screen, is the fact that most homeowners policies, and when I say most, probably in excess of 90 or 95%, have co-insurance involved built into their coverage form. And usually it's 80% co-insurance. So working with easy numbers, what does that mean? It means that if at the time of a claim, and this could be a partial claim, a kitchen fire, or total loss, let's just say, you know, $100,000. They come out and say, oh, it's going to be $100,000 to replace your home at the time of the loss. And you have 80% co-insurance in play, which means that you need to be carrying at least $80,000 of coverage to avoid a co-insurance penalty, but you're carrying $60,000. So they apply this formula that's right in the coverage form. It's right in the policy forms, where the amount you're carrying, which is 60, over the amount you're required to carry, which is 80, gives you a fraction. That's 3/4. That's why I'm working with easy numbers. And that 25% hit is a penalty to you. So if you had that $100,000 kitchen fire and you were underinsured at the time of claim, you know, you're looking at absorbing 25% of that loss. And many people don't understand that co-insurance exists in there, and that's why you really need to be insuring to. I mean, you know, we say 100% of replacement value because, you know, what happens in a total loss. So with that, I think I'm moving on to pass the baton to Michelle. I moved through that kind of quickly. Any questions that develop out of that, please, we'll answer them at the end.
Okay, so I'm going to talk about some common home insurance exclusions. So as Garrett touched upon, earthquake is an exclusion, and you can buy it back. So there is a buyback for that. Landslides and sinkholes are also excluded. Flooding is excluded, which you can buy a separate policy. It's not included on the homeowners at all. Wear and tear. So we get this call a lot. Wear and tear. So we have somebody that has, you know, the life expectancy of their roof is 30 years old and is just leaking, and we get this phone call, and there's no coverage because it's usually just wear and tear, you know, and they say it's just leaking because nothing caused it. That this is a common call because a homeowner's policy is not a maintenance policy for insureds. You have to keep up with normal things that need to be replaced. Also, infestations, bed bugs, termites, mice, etc., are not covered. One thing that is covered is actually raccoons. Raccoons are considered part of the bear family and not considered part of infestations. So we've had claims where the raccoons are actually covered if they're getting in the attic. Civil authority is excluded. Mold limited coverage may be available. There's a sublimit on some policies for this coverage. Wind deductible, if you live next to water, you would have a wind deductible because you're near the water. Trampolines. We have some companies that write trampolines and some that don't. So it really depends. It's important to let your agent know if you have this because it can be a problem. Pollution for oil tanks. Oil tanks are a big problem. We still have a lot of oil tanks in this area with houses. So we have companies that will write the oil tanks, but there is an exclusion for the pollution if they leak. So another problem that we see is a lot of home vacancy right now. So once the home becomes vacant and the homeowner is not living in it, we actually need to write a different policy. So this is something that you really need to talk to your agent about, Or if you're buying the home and you're doing renovations, which we also see, where you're not going to be living in it for a couple of months, this is also a different type of policy. So it's very important to know this and let the agent know so we can write the right coverage for you.
Again, we apologize for the lag time in between slides here.
Okay, so flood. Flood is not covered, as I mentioned, in the homeowner's policy. What is a flood? A flood is a general and temporary condition where 2 or more acres of normally dry land or 2 or more properties are inundated by water or mud flow. No home is safe from the devastation of a flood. 25% of flood losses occur to homes outside of a high-risk area. Property owners should consider buying flood insurance even if they aren't in a high-risk area. Just 1 inch of water can cost $20,000 or more in damages to your property. Standard flood insurance policy pays for direct physical damage to your insured property up to the replacement cost or actual cash value of damages or the policy limits of coverage, whichever is less. If you're not in a flood zone, the average homeowner's flood insurance premium is pretty inexpensive. It's $500 a year. Of course, if you're in a flood zone, it can be pricey. So we can help you get the flood zones and let you know if you're in the flood zone, which one you're in and how expensive it can be.
Yeah, I'll throw in 2 things here. In yesterday's webinar that we did, there was a lot of questions confusing water damage within a home for flood. So flood is indeed that definition that you see there. And that, by the way, that could be if you live in the village and there's a broken water main, right? And it causes that, that flood, surface water, entering a home. That's considered a flood. But, if a burst pipe, that sort of thing, and that's water. That's sudden and accidental release of water. That's covered under the homeowner's policy. And I'll also say that that flood premiums are on the rise. They have been on the rise. They continue to be on the rise. Significant double-digit increases by the National Flood Insurance Program are expected for the foreseeable future, just because it had been underfunded for a long, long time. So it's something that you can get out ahead of folks buying that may need flood insurance to start looking early. Being an independent agent, we have access to not just the NFP and companies that write with the NFP, but we also have some other private companies that have now come online that are deviating nicely in some cases from the NFIP premiums, which is set for everybody. So just wanted to toss that in.
Okay, so as we know, more and more Americans are operating a full part-time business. Statistics show there's probably 50% of people in homes that have a business. So you have to be really careful about business because there's minimal to no coverage of business in a home. Basically, you have $2,500 worth of coverage for your personal property limits, and your liability, it depends, what kind of business is in the house, but really there isn't coverage for a business. You need a business owner's policy. What really is a problem is you store business personal property in a detached structure for business use. That actually voids the coverage. And I know Garrett talked yesterday about a claim that we had years ago. I don't know if you want to touch upon that, Garrett.
Well, I mean, it was just one of those things. We try to be proactive with our clients. Every other year, we do a very robust 2-page questionnaire, just trying to make sure we're staying on top of things. And and this person didn't indicate anything about the fact that he had business anywhere in the home, and in fact, he did. He had storage, and when the claim adjuster came out, the discussion happened, and they actually declined coverage on not only the business property, but also the structure itself. So that detached structure, if you have anything going on in regards to business, you need to endorse the homeowner's policy, which can be done under certain circumstances, depending on the business that's going on, or separate coverage, separate commercial business owner's policy. I also have a son who's, has a music studio where he makes money at our house. So shoemaker's son, we got it done right.
Okay, so we all have kids that want to make money. So snow shoveling, landscaping, lawn mowing seems harmless, right? But at what point does your homeowner's insurance coverage end? Same thing applies here. There's a limitation for how much a young person can make. It's $2,000. So over $2,000, it becomes a business, and that's where you have a liability exposure. So you really want to make sure that if it becomes where they're making lots of money, you want to have the right policy in place and protect your liability. John? Okay, so the last thing I'm going to talk about are high value items. So high value items are part of the personal property coverage on a standard homeowner's policy. On a typical homeowner's policy, you have items like jewelry, guns, furs, coins that have set limits for theft. Jewelry is covered for $1,500. So what we really recommend is if you have valuable items, to schedule them on what's called a floater. Basically, it becomes all risk. So for example, with jewelry, if you lose the stone or you can't find the jewelry, you just can't find it, you don't know what happened to it. If you have it scheduled on a floater, it becomes all risk coverage, zero deductible. And based on your appraisal, you're going to get what you have it insured for. So otherwise, if there's a limitation on jewelry and those items that I mentioned for theft. So it's very important to schedule your valuables. And with that, I'm going to hand it over to Brianna.
You can ask my wife about. You can ask my wife about that, by the way, who lost the stone out of her ring. Covered.
So I'm going to start off by talking about fallen trees, which is a pretty hot topic with the storm that came through last week. So are they covered or are they not? It really depends. And the answer to that question is probably the opposite of what you think. If your neighbor's tree falls down in your yard, it has to hit a structure in order for your policy to provide coverage. It's not going to come from your neighbor's policy. It's your policy that's going to pay. So it has to hit either your house, a detached garage, a shed, your fence, a pool. It has to hit a coverage structure in order for there to be coverage, or it has to fall and block your driveway. If it just falls in your backyard, doesn't hit anything, there's no coverage for that. And as far as the amount that you have to get paid for the tree removal, there's a limit. Most policies, it's $500. Some policies increase that to $1,000, but there is still a limit of $500 per tree for that coverage. So what they'll do is they'll pay to lift the tree off of whatever it hits. But as far as getting it cut up or removing, if half the tree falls and there's still a big stump there, that's not going to be covered.
Yeah, and just to clarify, Bree, that's whether the tree is your neighbor's or not, right? I mean, that's if one of your own trees falls, if it falls, it doesn't hit anything, there's no coverage whatsoever. It actually has to be property damage involved. Right. Yeah.
So personal liability, in the age of social media with kids posting on Instagram and Twitter and Facebook and YouTube, if they say something inflammatory against somebody else, slander, libel, that's all going to fall under personal injury coverage, and that you could be brought into that even though it was your child that made this statement. So it's really important that kids are careful with what they're posting online. Personal injury coverage is not usually included in a standard homeowner's policy. It's something that usually has to be added. It's a very minimal charge. So it's something that we're always super aware of, that we make sure that the policies have that coverage. Another big liability exposure is going to be your animals and your pets. So most homeowners policies are going to have the standard aggressive dog lists that they're not going to write policies if you have these dogs. So it's your pit bulls, Dobermans, Akitas, sometimes German Shepherds. It depends on the company, how long the dog list is, what dogs are included on the list. So it's important that you let your agent know what kind of pets that you have in the house so they can guide you accordingly. Another big topic is drones. As far as a homeowner's policy is concerned, it's kind of a big question mark right now. They're considered an aircraft. So as of right now, there's no homeowner's policies that are going to cover your drones, and that could come into play with the personal injury coverage as well. You've got your kid or yourself flying a drone around and you fly over somebody's property and you're taking pictures or video, that can be considered an invasion of privacy and can get you in some trouble. So we're always going to recommend your umbrella policy, which is going to be an excess liability policy, and it's going to go over the limits on your home, your auto, any toys you have, like a boat, an RV, an ATV, a motorcycle, things like that. They go in increments of $1 million, usually up to 10, but we can get in excess of that if necessary. So when you're trying to figure out how much coverage you may need, a good thing to think about would be any cash you have on hand, like in a checking and savings account, any investments, 401ks, IRAs, any future wages, and any escrow that you might have in your house. If that totals over what's normally included on your auto or home policies, which is somewhere around 500,000 typically, then you definitely should consider getting that umbrella policy.
It's also one of the best buys in insurance.
Yep.
You know, for the most part, if you've got a home and a couple of cars, I mean, it can be as low as $150 a year. So.
So next up is the effects of multiple claims on a home. The more claims you put in, the more of a risk you're going to seem like to a company. So what we usually see is after 2 or 3, that company is going to look to drop you as a client and have you get your house insured elsewhere. So we are always going to recommend that you self-insure to at least a $1,000 deductible. That way you're not tempted to put in smaller claims that could end up getting you in trouble in the long run. And it's always important to consider how much the claim is and how high your deductible is before you put in a claim. So let's say you have a loss and the total is about $1,300. If you have a $1,000 deductible, we're probably going to advise you not to put that claim in just to get a $300 payout, just to save you the possible headache in the long run of possibly getting canceled by that company for putting in too many claims.
Yeah, we're depending on the home, depending on the client, you know, I mean, we're seeing, you know, $2,500 or $5,000 deductibles, you know, these days too. Obviously, it helps drive the premium down as well.
Home hospitality services is, I'm sure, a hot topic that you all see a lot as well. So your Airbnbs, your HomeAway, your VRBO. Homeowners carriers are still trying to figure out how to handle these situations. A lot are not providing coverage for it. And if they do, it really varies what kind of coverage they're going to provide or what the situation has to be for them to provide coverage. So you've got certain companies that have a limit of 12 weeks out of the year. You have companies that have a limit of 90 days out of the year. Some require that you rent out the whole house. Some require that you're only renting out one room. Some say it has to be your primary home. Some say it can only be your secondary home. So it really just varies so much from company to company. So it's very important that you talk to your agent and let them know what's going on. That way they can find the company that's going to be the best fit for your situation.
I think the critical thing here is, this is going on all over the place now, is that you need to talk to your agent about it, because I think there's a lot of it going on where, you know, insurance carrier or the agent just doesn't know, and so there could be significant gaps in coverage.
So does your credit score affect your premium rate? It does. What we run is what's called an insurance score, which takes your credit into consideration. So our companies show us a tiered rating. So like one of our companies has literally A to Z. So A is really good. Z is either no score or it's a no hit, which could mean that you probably have a credit freeze, which a lot of us do because of that Equifax breach a few years ago. So all you would have to do is just call one of the 3 credit agencies, ask them to lift that freeze for 24 hours, and have the agent run the insurance score again. And you could see that premium drop once they're able to get that score for you. So it's important to get those annual credit checks. They're free, and just make sure that everything looks good, because the better your credit, the better your premium is going to be.
Yeah. Also, correct me if I'm wrong, but some of our companies will look at, if you've got a husband-wife, if credit is great on one spouse, not so great, you can run it on the one that has the better credit, and they'll use that
Yes.
credit for pricing.
Yep.
Right? Yeah.
They'll let us flip it. And we also have a couple companies that will, if your credit's not great to begin with, and a couple years down the road, it's better, they can reevaluate. And that it can only ever drop your premium. If it increases the premium, they're not going to do that. They'll keep your premium where it's at. But if it's going to make your premium better, we can usually work with them to get that premium lowered. So now all that's out of the way, we can talk about the better things, which is all the ways that you can save on your homeowner's insurance. So you have your new home discount, which would be, usually we see 20 years old or newer, and the amount of the discount varies based on how old the home is. Your claims free discount, so it's super important to really think about whether it's worth putting in that claim or not. Some companies do offer a retirement discount, whether it's one person in the household who's retired or it's both you and your spouse or your significant other. A longevity discount, which is something that you're not going to actually see listed on your policy, but once you've been with a company for a long time, you do have a credit for that. So it's something that we definitely encourage when somebody's looking to shop, just to think about, if you've been with a company for a long time, you are getting that longevity credit. Any alarm system or burglar system, like an ADT, central station alarm, or even some companies are offering discounts for like a ring system now. Fire extinguishers and smoke detectors, any home improvements, if you've done any updates to your roof, your plumbing, your electrical, the heating systems, generators, whether they're hardwired or portable. Some companies give discounts for both. It'll just be a higher discount for that hardwired generator versus the portable one. A water detection or automatic shutoff system, non-smoker discounts, and then of course you get the multi-policy discount. The more policies that you have with that company, the higher the discount's going to be. Usually on the homeowner's side, the average is probably around 20%, a 20% discount for having your auto policy with that same carrier.
Okay, we ripped through that. Cognizant of the time, hopefully we have I'd love to have a robust conversation, a good question and answer session from folks on the topics we covered, or anything else in regards to insurance and how it relates to your business, that sort of thing.
So I definitely have some questions, but I don't want to dominate the question asking. So I don't know if Diana or Jonathan, if you guys picked up any questions off of Facebook or through the Zoom chat here. But if not, I'll go ahead.
Yeah, Jeff, you can go ahead. There are no questions on Facebook yet. Okay.
So the whole replacement costs. So, my wife and I have a brick building, and the replacement cost is astronomical there. And it's always been a little bit of a bone of contention for me, and a frustration, I guess you would say.
Mm-hmm.
So anyway, just stopping the screen share so that everybody can see the speakers here. You had mentioned that the replacement costs, and this is my questioning of the industry as a whole, not just you, Garrett. All right, so don't take this the wrong way, my old buddy. Does not location have something to do with it? I mean, in other words, you could have a mobile home on an oceanfront lot that is worth $3 million, and the replacement cost sure as hell isn't $3 million. So you had made a comment before that largely what the insurance carriers are doing is they take a look at the market value of the home and they tack a little bit on, essentially. That's kind of how I heard it. Maybe that's not right, but that's what I was saying. So what about location? How does that play in?
Yeah, location does play in, Jeff, but when we're using a third-party software or the company software to try to nail down as best as possible 100% insurable replacement cost, right? It's going to take location region into play, but not for the reasons maybe that you're saying, which are more market-driven. This has a nice view, right? It's a beach, house. It's more about cost of materials and that sort of thing in that given region. Cost of labor, that sort of thing. So you'll find higher insurable replacement costs for, let's say, down in the 5 boroughs, or places like that. But it's more driven by labor and cost of materials than it is location.
Okay.
Location will drive market values for sure.
So, but at the end of the day, when you're referring to market value, you're talking about the market value of the real property, the whole thing, right?
Mm-hmm. Yeah.
The real property, the buildings, the whole thing. So the insurance company has their own way of determining value.
It's basically foundation up, right? It's actually the cost to repair, restore, replace the building in question that's been damaged.
So it's a cost approach to value. It's not a market approach, is what I guess what I'm saying. So they're simply taking the cost approach and the market value of labor and materials in those marketplaces.
Yep. And that one a big aspect, which of course is if you have half your buildings destroyed, it's got to be demolished, let's say, the costs associated with that debris removal and what's the word, the demolition aspect can be astronomical.
Okay.
Yep.
All right. I'm just going to keep going here, Jonathan. You can feel free to interrupt me. You mentioned raccoons. What about squirrels?
Vermin.
They're the destroyers.
Yeah,
I know. I know.
Yep.
So they're not covered, obviously.
Not covered.
Vermin.
Okay.
Yeah. Yep.
And how do they know the difference between a raccoon and a squirrel? Bigger hole?
Well, I don't know.
How's that determined by the adjuster?
Usually they can tell from droppings and things, and that's usually what I've heard.
Yeah. Or it's been seen, or the
homeowner.
It's been seen, right?
Michelle.
Yeah.
The homeowner takes a picture,
right.
I mean, that sort of thing.
So is Garrett the one to go out and decide which feces?
We have great claims adjusters for that.
Right.
Yeah.
All right. Just joking with you. All right. So this is a big one. This business in the home thing. All right. Now, I am not going to disclose where I am doing this video from. Not going to disclose that. It could be in France. It could be at my office building, but it's not at my home.
Right.
So realtors all work from home. I mean, come on, let's be honest. So there's
Sure.
1.3 million people running around the country with probably no home business designation on their home insurance policy, right? Or very few of them do. So, and in today's day and age, now we're seeing everybody's working from home right now. So what's really the deal on that? Because that impacts a lot of people that I lead in my industry, and I want to really know what the heck I'm talking about. And part two to that question is a guy like me who, owns a business, the real estate agency, and I have a business owner's policy in place for that liability. Does that cover business that I do in my home? Maybe yes, maybe no. Like, how do those play together?
It does. I mean, a comprehensive general liability, which is part of the BOP policy, the business owner's policy, does track with you, Jeff. So the key here is that if you have an office in the home where you have people coming, right? So you've got various businesses, piano teacher. My mom taught piano, right, for 42 years, You can endorse the homeowner's policy. It's a very inexpensive endorsement. It's like, I want to say $40, just to extend that business related exposure. Companies are going to shy away from businesses that have offices in the home, like with a separate entrance where they've got traffic coming in and out every day. They've got employees maybe in the home. They're going to say, hey, no mas, you got to get a commercial policy for that. And then some homeowners carriers will have an issue with that. They won't even want to write you if they know that exposure exists. So, I would say anybody that's operating out of their home as an office, even if they have minimal to no traffic, heck, even if a UPS delivery comes that's business related and something happens with that UPS driver steps in a hole that you just dug or something, that could create a bit of an issue. So I'd say if there's any work exposure, just talk to your agent about extending the incidental occupancies, I think is what it's called, the ISO version of that. It's peanuts, and it just gives you peace of mind,
Yeah. I mean, most realtors are not having clients come into their homes. They just work from home in their dining room or their spare bedroom, or if they're fortunate enough to have an office carved out in the floor plan,
Yep. If that's the case, there's probably no need to have it.
Okay. All right, that's good to know. All right, I guess that's it for me. You know, what I will say is that Sealy and Derland is an insurance provider of mine, and they're an absolute pleasure to work with. They've got an awesome team. They're led by Stu and Garrett, who are just great people, consummate supporters of our community. And I love to give business to people like that, you know, so it's a good organization. You know, your money's going to a good place and it's paying it forward, so to speak, right?
Oh,
So we always want to support people like them.
I appreciate
So,
that, Jeff, and I am sincere when I say that we'd love to be the go-to for anybody, a resource, if you will. If you've got questions, concerns, please just pick up the phone and call us. We'd be glad to help out.
that's great. All right, well, I think that's a wrap, Jonathan. Unless you have something else coming in, I think we're good to go.
All right, Jeff. Thank you so much.
All right, everybody, take care. Have a good one.